Hi and welcome to the SI Experience. It's Chris Doughty here. We hope you're well. It's a Thursday. It is a very exciting day. As normal, we have so many people, so many guests, and we're absolutely excited. And it's a very good personal interview today with my number two, who's an amazing individual, Del. Today, we're going to be talking through about his experience of 20 plus years in being in private equity, buying and selling millions of pounds worth of companies and assets, and really understanding from a industry level the tips and tricks, and more importantly, the experience of Del and what he has found and how that is related to not just himself or giving you guys war stories, but actually how it means and what does it mean to be an investor and relating that to property. So without further ado, I'll bring him in. There he is. Hey, Deli.
Hello.
How are you?
Very well. Slightly warm in my south-facing office, but apart from that, all's good.
So I don't really need to do much. I've done a bit nice introduction and stuff, but obviously we work together every day. I probably speak to you more than my own mother. So I think today's going to be quite a relaxed personal experience. But for everybody who hasn't watched the SI Experience before, etc., just why don't you tell us a little bit about, I know everything, but for everybody here, why don't you tell us about who you are, what you do, and how you're here where you are today?
Sure, yeah, well, I guess out of university, I trained as a chartered accountant. Very quickly, that took me into mergers and acquisitions. So advising businesses and investors on making acquisitions in UK and Europe. I would help people sell businesses, buy businesses, do management buyouts. Most of this was in the kind of 10 to 100 million quid kind of range, and lots of sectors. I sold clothing businesses like Fat Face, that some people know, car park factories, house builders, e-commerce websites, a whole gambit. And then, having been an advisor, I went investor side, private equity funds, using other people's money, so other investors' money, investing. And firstly, I did it in distressed assets. I worked for a fund where we focused on bankrupt companies and trying to affect turnarounds. And then I did larger businesses across Europe in a second private equity fund before branching out and doing it by myself. I was doing a range of private equity work by myself, and which led me to making investments myself and getting involved in SI, and here I am.
So just for people that are uninitiated, mate, is we talk about private equity, and we know what that is. We've both been sort of in that world of finance and etc. But for a lot of the people watching here today, they don't. What is private equity in its simplest form to explain to everybody?
So really, the model of it is here's a sort of started on time in the 70s, I think, but there are lots of private equity funds. It really is bringing together other people's money. So it could be at one level taking in pension funds and other kind of large asset managers, taking allocations to those people. It could be a handful, it could be 50, into a pot of capital, and then using that money to invest in private companies. And different private equity funds have different themes and strategies, different deal sizes, different geographies, different types of deals they specialize in, different sectors. And you invest that money on behalf of your pot of capital. Typically hold assets, but 3 to 5 years would be pretty normal, and looking to make obviously profitable venture return on the way out. So you're obviously similar to a house. You're sort of buying into an asset, you're making money and income whilst you're in it through dividend rather than kind of rental incomes. And then at the end of it, you're hoping to sell an asset, a more valuable asset than you started with, because you've grown it, or profitability's grown, or you've made it more attractive. So that's it in a nutshell.
So again, so you yourself and your role was really specialising in finding deals for private money to invest in. So I think we've got a few questions which I think hopefully will be very interesting, exciting for people. And everybody on the call, just please at any time don't think that a question is not valid that we can't ask, even if it's property related. So from our side, you find deals. So how does anyone find deals, and what did you look for yourself?
Well, I guess it starts from having a very clear strategy and understanding. You've got to understand yourself, your own strategy and parameters, before you can communicate that readily to someone else. I think there are people out there, both in that big ticket investment world and also down at the, kind of the smaller kind of investment and property world, that sort of have this, well, I'll look at anything. I think if you tell people you'll look at anything, you'll see nothing or next to nothing. You almost have to be remembered for something. You almost have to be pigeonholed. So having an idea of what's the smallest deal I'll do, what's the biggest deal I'll do, what would be my bread and butter, what are the parameters for it? Are you looking, I guess in the case of our property world, are you looking for, shiny, newly built, fully tenanted, lowest risk possible on long-term contracts? Or at the other end of the scale, are you looking to buy, brownfield piece of land and do a development from scratch? Or, buy a building that's on sale as a lot of fire damage, like the really tricky end. So being very clear to people who might show you those deals, whether they be estate agents or landlords or people who've got networks. So I sort of think you've got to be remembered for something. I also think you've got to take account of with the people you're networking and dealing with, thinking of what's in it for them. We just talk about whiffing, what's in it for them, or what's in it for me. Translating it to the person, how are you being helpful to them? What solution are you being providing to them? Are you helping make them money as an estate agent? Are you helping them make look good? Are you helping to solve a problem that they've got in their landlord portfolio? And then the next thing is, clearly it's being networked. Chris, that I've sort of spent my life doing this. I feel like I drink tea for a living. I've spent a lot of time building a massive network and a huge LinkedIn database and all sorts of contact spreadsheets of people that can help me find deals. And it ends up, people say, where does my deal flow come from? And the traditional place for businesses is corporate finance. The same way as in real estate or in what we do, it's estate agents. But deals could come from all sorts, and I get deals from accountants and lawyers and friends and various various sort of company advisors, and it's just about being networked and being networked well. But also within a network, I generally believe in partly sort of being liked, kind of be efficient, be decent, give people a reason to come for you. Some people might come to you because you're seen as being the person who overpays for everything. Great. Some people might come to you because they like dealing with you as a human being, and some people might come to you because they just know you're efficient. If you're gonna say no, you're gonna say it quickly. You're not gonna lead anybody on. You're not gonna change the price at the last minute. At one of the firms I dealt with, they had a habit of in corporate world, you sign lots of non-disclosure agreements, and they're pretty standard. And frankly, nobody ever gets taken to court over them. And I used to say, marking up those documents and sending them back markup causes someone at the other end a problem. You're just causing admin. And I'm like, don't do that. Don't cause admin. Don't make yourself difficult to come to. Just because those guys, they'll just go, do you know what? They can send it to lots of people, and a property can be sent to lots of people. Make yourself easy to talk to and easy to deal with. And then the last thing I think is if you yourself can make yourself an expert, you make yourself efficient, because you make yourself very quickly to be able to say yes, no, yes, yes, no, no, yes. And for the people on the other end, again, that quick and efficiency of response is key. And I think that sort of keeps coming back, seeing that you're effective and efficient to deal with.
So when you say be an expert, and again, we from our side, we do mentoring with a lot of clients who are coming through weekly. But being an expert in the world that you were talking about comes from experience doing deals and etc. But how would you advise anybody on here? How do you become the expert yourself?
I think it's a combination of things, isn't it? There's a baseline education and training in terms of being taught. I sat in classrooms ranging from chartered accounting exams, which I wouldn't want to repeat again because they were horrible, learning some broad line fundamentals, and then getting into the specifics of my field. So sitting in corporate finance courses about financial modeling or how to do company valuation or how to do negotiation. That sort of learned kind of formal environment training. And then I started to sort of read around my topic, both I guess hard topics and soft topics of how do I get better at networking. That's a sort of slightly intangible thing to go and read around. Whereas at the same time, I'm going, okay, at the time I'm involved in I don't know, distressed transactions. What I need to understand what a company voluntary administration is. how do I, what are the mechanics of that? So that's much more, you know, kind of, I can actually go and learn something solid. So there's a self-taught element, and then of course there's the experience part, you know, kind of, and there is a bit of, and again, you and I see this, the people who like educate and educate and educate and educate, and they want to be educated to the nth degree until they'll pull the trigger. And I kind of think, you know, I remember at Arthur Anderson, we were sink or swim. They used to push us right out in the headlights as a 2-year graduate and go, there you go to that board meeting. And I remember my knees are knocking together, you know, thinking, how on earth am I going to get through this? I have no knowledge. And, you know, you do it once and it wasn't quite so scary, and maybe not perfectly, and maybe I did it very differently 5 years later, but, you know, I got through it. So, you know, there's no substitute for, at some point, you know, kind of pulling the trigger and getting on with it.
Yeah, and you know, and I think that's definitely advisable in what we see with people, right? Is there comes a point where you can only learn so much, you know, from a book or from a mentor, etc. But having that mentor and long-term support is great, but like you would have that, you know, corporate structure around you at Arthur Anderson. But there comes a point where you've just got to do everything that you can, but there is the element of pulling the trigger and learning probably even more rapidly by pulling the trigger.
Yeah, absolutely. And you sort of go, you know, get based learning, pull the trigger, carry on learning. You never stop learning. You know, there's plenty of nice quotes out there, you know, Albert Einstein and the like. Carry on learning, but I guess, like you said, if you can get the mentor support beside you, you're a bit like me in that world. I'm like, well, at least I'm working for a partner. If I'm really scared, I'm going to call him up and go, I don't know what I'm doing, boss. And it's the same thing, I guess, having a mentor and being able to say, I thought, and it's that comfort, isn't it, of sort of going, I think I know what I'm doing here, just like to check. And 9 times out of 10, you were spot on, but it's quite nice to have the comfort of someone saying, yeah, you're right, carry on. And then there's a few times someone will say, well, yeah, you're on the right lines, but maybe think about doing it slightly this way. And then every now and then there's the, no, don't do that. So there's huge value in having that person beside you who can, you know, kind of give you that guidance.
So we found a deal. Does that make sense? Mm-hmm. So we talked about, you know, how do you find the deal in the first place and what you've looked for. We'll discuss that. So I think the second sort of question is, you know, having found the deal that works for you, so this could be a potential property, it could be a potential, you know, company in your world. What approach do you take, you know, with regard to due diligence of that business or that asset for purchasing? What do you do?
Well, I guess it's no different in terms of buying a company for hundreds of millions versus, you know, buying a you know, property for 100 grand. You know, it's do as much homework as you can do before you sort of committed to acquisition, and you know, sort of appropriate for the deal and in the time available. You know, I've done deals where they went on for months, but we could, you know, turn over every last stone. You know, we're always like doing due diligence on due diligence and boring ourselves to death about how much due diligence we've done. I've done other deals. I think when I was doing the turnaround investing, I think the fastest we did was about 11 days. And it's like all hands to the pumps, you know that you're not going to get to turn over every stone, but that's reflected in the price. And that can well be reflected the same in a property deal, right? You know, motivated seller and the opportunity is to do, you know, a cash deal in a very short space of time, but you're probably not going to get to tick all the boxes. And that's part of the reason you're paying such a discounted price, right? Now, obviously, exactly the same in property as in companies. The moment you involve lenders, you don't get to take flyers. You know, lenders aren't going to buy without the full DD. So, you know, they're going to need more and they're going to want more. So that changes that kind of script. I guess the part for it for me was about finding, you know, go out and find those experts. There's the obvious thing of the surveyor, for example, you know, kind of, and then obviously your legal due diligence and etc. But if you're going to go the next level and kind of start thinking, okay, do I need a full flood report? Do I need a full you know, engineering survey on this? Do I need a report about, I don't know, knotweed? You know, and going to those specialists and finding experts who are appropriate. So, you know, going and getting Clifford Chance, one of the biggest law firms in the country, to look after a, you know, £2 million acquisition in my world would have been completely inappropriate. They wouldn't really have been that interested because it's not a lot of fees to them and what they bag. It's same in our world. You know, use experts. You wouldn't go and use Savills to survey your probably 100 grand property in Liverpool. So people who are appropriate and motivated, outsource where you can for efficiency. You know, kind of if you and sort of ask what is number one, what is better, using an expert? What is more time efficient by outsourcing it? But then what can I do myself? And being clever about who can I contact. So in my old world, it was, can I find other sector experts? Can I find people who previously worked in this business? Can I find people who are connected to the management team, i.e. the CEO, who can find me out? So again, I think about our property example, Chris. You'll remember I was looking at a deal in Liverpool, and when I was up in Liverpool, I dropped into 2 lettings agents nearby. And so I said, one of them I told I was coming, the other one I didn't. I just happened to walk off the street. And I got invaluable information, and they knew everything. They knew the landlord, they knew the agents involved, they knew about one of the potential builders I was going to use, and boy, was that helpful. They had so much information. It was so telling. And in the same way, in my corporate days, we actually went and did some homework. Basically, we used LinkedIn to find the connections to a CEO. You sort of go, when you're doing private equity deals, the management team is so important that you really want to understand the story. And we found out by hook or by crook, just by doing some desktop and making a few phone calls, that the guy was an alcoholic, or the strong impression was that he was an alcoholic. And we're going, well, we're about to back this guy with tens of millions of pounds, and is this something we want to do? Now, and the deal ended up getting pulled, and that wasn't all the story, but it was certainly part of the story. And again, remember, Chris, I was looking at another parallel, looking at I was looking at an investment in it was near somewhere in South Wales. We'll come back to it, sort of Bridgend kind of direction, in the valleys there. And
Bridgend, yeah.
I was thinking about, and it was quite a big commercial resi redevelopment. And at some point, I got some sort of alert somewhere about flood risk. And it didn't actually found on YouTube video of the entire street that I was planning on investing into under about 3 feet of water 4 or 5 years ago. That's like, it's just saved me a whole load of money. Before I'd done the survey, appointed lawyers, gone off to try and get out planning permission. And I'm like, well, stop. Here is, virtually the property I'm going to invest in. And that is, that's easy homework and free homework to do to stop me spending money. So yeah, I think a bit around the topic of who can I call. The lettings agents really have been brilliant with the property stuff.
And even in the short period of time that we've been working together, I think that's something that I've always said, and a lot of people say that at the end of the day, from a property investing perspective, you've mentioned the lettings agent. The reason being is because they're the manager of the asset after the fact of acquisition, and they know demographics, what the demand is, they've been operating in that area for such a time. So asking some pertinent questions of, like with any deal, working from the not from the front and working forward. You actually work from the back and work in the reverse way around. So find out what it is in the area, what's going on. So we talk about
just to add to that as well. When you get reports from a surveyor, and it's the same in corporate world, very rarely will anybody give you an opinion, because the moment they do that, they open themselves up to potential liability and exposure by saying, oh yeah, PS, what an amazing property, I would definitely invest in this. They're being very factual. What's interesting to do as an exercise is to go back to people, and they won't put it in writing, but say, out of interest, what did you think? If you can get to the actual surveyor and say, what did you think? Would you do this deal? Or if the lawyer's saying, there's this particular issue with title, go back and say, what do you reckon if you were me? Would you do it? And then again, you won't get it right, but you're getting it from an expert. And I can remember doing a due diligence thing we were doing a 50 million deal in Holland, and saying to this PIP, we'd spent 150 grand getting this report done, and it was 2 inches of paper, but there's no opinion as to whether the company is good or bad, just fact after fact after fact. This is good, that's bad, this is good. And at the end, when I had the partner in the room, I said, well, come on, what do you actually think? And he said, in 15 years of reporting these reports, I've never seen a better business. I would invest in this myself if I could. And I'm like, oh, isn't that telling? But again, I wouldn't have got that. I wouldn't have got it in a report. I wouldn't have got it as an ask. Yeah. So ask.
Yeah. If you never ask, you never find out. But I think at the same time, there's that balance, right? Of you get opinions from the advisors, and if we relate it to property, your solicitors, your surveyors, etc. You bring that input, all of it together. But ultimately, by bringing in all of this information, you have to be making those decisions yourself. Because if you are just one of these people who, like in that case, it's you're making a decision. I'll give you an example. People will turn around and go, well, I'm investing in Manchester. Oh, right, that's where I'm going to go. If you just went on one person's information, etc., that's not really doing yourself any favors. But in actual fact, ultimately, whether you're investing like with yourself, with the businesses, you're making the decision, right? So you have inputs from all of these experts, etc., to give you the best picture possible.
Yeah.
So one of the big part with companies, etc., was, and again, we're trying to relate all of your experience in these multi-million dollar deals and pound deals in terms of valuing assets. So assets being the company, in this case, what we're relating it to is property. Is there anything in the process of how you would value a company that relates to property?
Kind of. I guess in company world, there is a load of accounting and corporate finance theory about how to value companies. And one of the ways that we do that is relevant to property is we look at comparable transactions. So, when I'm looking at the, selling fat face, then I'm looking at other clothing companies of similar sizes who might be listed or recent transactions that have happened. And the same thing, you look at, kind of what's for sale, what asset is what similar assets are for sale, and obviously what's been sold. The two things that can be very different. Sold is obviously, it's a version of reality, but it dates, so it was sold, but when, 1 week to 1 month to 1 year ago, and what are the differences to your asset, and what were the differences in circumstances? So I went on no end of courses about economic, kind of company valuation theory and discounting cash flows and blah blah blah, and you end up at a very basic level, I guess, coming back and saying that's all well and good, the theory, and we would produce these valuation reports that go under this method it's that, and under that method it's that, and there'd be all these different numbers that come down to some form of judgment. And at the end of the day, with all things, it's willing buyer and willing seller. What is someone willing to sell for? What's someone willing to buy for? And part of it is understanding the needs of the seller and the wants of the seller. Does the seller have to sell? That's a key thing. That changes things. And then if the seller has to sell for a reason, what's the reason and how much do they need? If it's, I need to sell that property to shore up my business, and if I don't get 120 grand for it, doesn't solve my problem anyway, so there's a floor price. And it might be, I want to sell it 150, but I need to sell it 120. So trying to sort of get your head around who is selling and why, and if there's any reason what's it, and try and get into the vendor and having some sort of, kind of softer conversation. Has it been on the market for a long time? Are they trying to move? Have they been in 3 processes that have fallen over? The house that I'm sat in, the lady, so I definitely, with my due diligence hat, I was like, right, I'm going to go and meet the seller. And I meet the seller. The estate agent didn't blink when I asked, which kind of surprised me. I thought they'd always kind of trying to keep them apart. I met the seller, and she discloses to me that the property was up for sale, and they lost the buyer, and that they're already in a small chain, but they found the property they want to buy, and it's up the road. And I'm like, well, you're telling me everything I need to hear. You're a pretty motivated seller. And guess what? It was an offer, some ways significantly below the asking price. I made one offer, take it or leave it, not a let's negotiate up and down offer, and got it at the price I wanted. So there's that willing buyer, willing seller. I think if I think about the financial modelling I did, there's a bit of me that always thinks do it both ways. So don't start with the price that is advertised and think, okay, if I pay that and these are my expenses and that's the rent and blah blah blah, what's my return? I want to do doing it backwards, kind of going, okay, if I invest some money and I need to make this return, what can I therefore afford to pay for that property? So kind of do it in both directions. And it might be once you start from one, going, oh, I sort of get it. Go back the other way and kind of go, well, hold on. If I want to make, if at the end of the day, I want to make, 15% net yield to my invested equity, I can afford to put this much equity and I can get this much bank debt on it, and that says rather than the 240 asking price that I started with, I can really afford to pay 225 and doing it that way. And then there's a bit of that. How do you price for the, I quite like I describe it as the non-vanilla, the things that are sort of slightly outside the ordinary, because that's why I think, opportunity lies, particularly in pricing. So I have gone after things that are quirky, to say the least, and I couldn't mind the things that have been, had a fire in them, or got subsidence, or got the river running underneath it, and and we had it again. If I think about one of the deals I did in Europe, where there was a business for sale, it was quite a nice business, but people generally wouldn't go near it because the two founders didn't really like each other, and they were basically kind of at war, and that meant that people were worried that they do a load of work, spend 6 months trying to buy it, incur hundreds of thousands of costs, and then one of them has a meltdown one day and the deal's off, and there was a high level of risk. So we decided that we would do it, but a heavily discounted price. Well, not heavily, but certainly a discounted price compared to what you would be paying if it was, everything was in roses. And similarly, I'm looking at a deal at the minute which it's got Japanese knotweed. Now, so you're into a whole, kind of 5-year plan, treatment plan, etc., and what you can do, what you can't do, and the result of which is that no one will go near this property because they just sort of see it as aggravation. And I think, great, I have aggravation, and if that means that property is, there's a chance that it may make it unfinanceable, and I'll have to do it all for cash for a period, 2-3 years. Now, that might be the opportunity in itself. Or it might be I've got to go down the sort of specialist lending route, and it will be more expensive finance. But both of which are fine because that's all reflected in the price.
Yeah.
So I quite like that non-vanilla and how that sort of plays into valuation.
And again, what you've described there, just as sort of for everybody, is really, you've got to be able to do your due diligence, but at the same time you've got to look at what is it worth to you, and I think a lot of people. Especially when they're potential buyers or investors, they see a sell price and they think that is the number, or it might be somewhere near that. Well, in actual fact, you've got to run it for yourself, like you said, forwards and backwards. If that's what the initial price is, well, then you've got to work out what your circumstance allows you to afford, how aggressive you want to be, combining that with your strategy. So, for example, if you were intending to get in and out of a deal, you're probably, from a flip strategy, you're probably going to be a bit more aggressive on your price, in the sense of it being lower because you want to get in and out. Whereas if you're taking a 10 to 15 year view and you're looking at that from a cash flow perspective, you can probably be a little bit more closer to the asking price if that works for you. But you have to look at this scenario-based planning.
Yeah.
So let's put it this way then. You've got a multi-million pound company, and you're looking at buying it. I'm guessing there's not just any private equity deal, etc. doesn't just use 100% cash or equity. And I'm with regard to purchasing any sort of asset. So in property world, the best thing for any investor is being able to leverage in order to acquire that asset, which is one of the few asset classes that any Joe public like myself or anybody who's watching can actually lend against it. You can't lend against it in stocks and shares, etc., unless you're a very complicated investor. But you would have used a lot of bank lending. So I guess the question is you've probably used a lot of bank lending, or leverage, as we call it, to get deals done. And I'm guessing this is just the same as, for example, somebody like me using mortgage finance or refinance or any bridge lending or private lending that I use to structure the deals. But what advice can you give investors on this topic?
It's much the same, to be honest. So you're absolutely right. So professional equity investors, use lending in much the same ways. They I guess fundamentally to enable them to put less money into the deal. Of the £100 million deal, I've got to put in 30 or 40 million of equity and 60 million of banking, and then also exactly the same impact of, and what does that do to the overall return on my equity? Exactly the same way as property, and just in the same way, there's good and bad that comes with using leverage. Like you say, from a consumer perspective, it's pretty difficult to access bank debt to acquire assets out there generally, to make your money go further, other than in property. Now, again, it's a fundamental tenet. If you can find assets where the gross yield exceeds the cost of finance, so gross yield is 10, cost of finance is 5, then that bit that's leveraged, 60% of your deal, you're already making a sort of 4% net gain, because it's costing you 5% net gain. That's my maths. It's costing you 5, and you've got 10 of income. Now, and obviously that therefore starts to improve your return on equity and your net yield. And then obviously where it gets really exciting is when the value of the asset increases, then you get the increase in the effective leverage and the super juice that has on the returns on the disposal of your asset. But you and I see it in property training. People only talk about it as a one-way bet, and you have to be aware of the downside too. If you're 80% leveraged on an asset that costs 100 and you've got 80 of debt on it, and asset prices drop by 20%, your equity is gone. And I think in some ways I'm kind of glad that the days of kind of 90% plus LTVs. When I was a chartered accountant, you get 100% mortgage. You're kind of glad that that's gone, because any little bump and you're into negative equity. But markets have short memories, and whilst right now in the middle of COVID-19, LTVs will definitely be going down. The market has short memories. I've seen it after 2002. I've seen it after 2007. All comes back at some point. So absolutely, I am an advocate of using leverage to a point. I saw it in private equity. People would leverage them up as high as they could to sort of maximise the return on their equity. And you've got a business there with a load of staff and employees and the management team kind of knowing that any little bump in the road, a couple of months of bad training, and they're deeply in the crap with a lender. So I'm sort of saying, be sensible, give yourself some room for bumps in the road. Remember, if the tenant stops paying for some reason and is able to stay in your property, or there's a fire and you need to renovate your property for 6 months, or etc., or for any reason that your property, isn't producing the full yield that you intended on your model, you still got to keep paying that finance. So, I guess what I don't want is, don't become the motivated seller yourself. We talk about dealing with motivated sellers. We want to go and find those people. But yeah, let's not become motivated sellers. Again, and I've seen it in the big corporate world as well, on the distress side of, we bought plenty of assets that had been other people's private equity investments with lots of leverage in them that had a bump in the road, and it all gone south. And the lender would have got back, maybe on a deal, lots of their money. The private equity firm's money is gone, 100%.
And I guess what you've just talked about there sort of leads us nicely. You're looking at a potential deal, and you've also got to look at the upside and downside, and what you just and what strategies you employ in either protecting yourself or your clients. And I think if I'm going to sort of just jump in there quickly, you talk about scenario-based planning there and looking at the upside and downside, and more importantly, at what point is your break-even point? So, for example, in simple terms, to the guys on the call who are here out there, if you've got a 5-bedroom HMO, you don't run it on full occupancy at 52 weeks of the year, based upon your best case scenario. If you ran that deal on before you acquired that deal on 10 months, for example, if you wanted to be quite aggressive, and 4 rooms, would that wash its face, for example, or is it 3.5 rooms to wash its face? And using that means washing its face means it still runs and looks after itself, so the income is equal to the outgoings, including the cost of finance. So if that's how I run my numbers and do the scenario-based planning, what strategies on a £50 million deal, pan-European deal, are you looking at to employ and protect yourself and your clients? Is it similar, or are there other strategies that you can employ?
Yeah, very similar. We would financial model these things upways, downways, and sideways, and become extreme Excel geeks. And we would you sort of build a base case plan of what we expect, and we run a few models to say what if we happen to do better than that by 5%. But really, we're interested in what's the downside, and then you start thinking, what can change? Fewer sales, or margin slightly worse, or more marketing costs to get there, or this particular KPI. And exactly as you say, we start looking at, what's our kind of break-even analysis, and if it goes bad, how quickly it goes bad, particularly given what we just talked about, leverage. How quickly am I starting to not, in fact, make returns at all? How quickly am I starting to lose my equity? So absolutely, that stress testing, build yourself that financial model and have a little play. What happens if you turn it from 52 weeks to 48 weeks to 44 weeks, and what happens if it's one room and 2 room? What happens if your rent per room's gone from 99 quid to 90 quid because there's been, we saw this. Remember the Doncaster thing? It was like the world and its wife at one point wanted to do HMOs in Doncaster, and you end up with a load of people descend, sort of herd mentality in one place. Well, pretty quickly HMO room rates start to go down. So, have you built that into your model? In terms of your costs, have you allowed for inflation over time in everything from broadband to utilities, etc.? Have you thought about what happens if wear and tear in your, this is an interesting one, when we saw something around somebody who sort of changed from HMO to a short-term accommodation strategy, and what they haven't really factored in is you've now got people coming and going, not least for suitcases, but moreover, don't really care. They're there for the weekend, and they were trashing the place, and the repair and maintenance bills went through the roof. So what seemed like quite attractive because there was more revenue around, net it was worse off. Yes, there was more revenue, but there was so much more maintenance that it was better to be back in HMO world. So, and then in terms of my thinking about my downside, I'm always thinking, if there's a problem or a disaster or an issue, or it doesn't turn out to be as expected, what's the quality of my asset? What's the value of my underlying asset? Because, obviously, if I've done something where I bought something for 100 and I've spent 50 grand on it, but it's still only worth 100, and things don't work out and I've got to sell it, I'm out of the money immediately. So I guess I'm always looking at it thinking, if I bought it for 100 and I've paid out 50, I'm hoping that I've added some value and the thing is now worth 155. It at least allows me to sort of get out clean, Yeah. And then my own view of property investing on a personal level, when I'm looking at it, I'm generally looking at things where I think, my exit strategy includes I can get out whole. If my downside is I can get out whole, then that really sings to me. But and then there's in terms of the ability to exit, how easy is it to exit? And I think and I did it again, going back to the company level, when we were doing distressed investing, we are investing with businesses that predominantly have gone bust, okay? So there's obviously something wrong. And we're buying them very quickly with limited due diligence. We used to sort of say it's like catching a falling knife. And things are always worse than people are telling you because everyone wants to be rose tinted. And so we always had to plan for, if this doesn't plan out, can we break it up? Can we sell pieces off to save the part? Can we just turn it into assets and sell the building and the forklift trucks and we get our money back that way? Or can we sell it very quickly ourselves for more than we bought it for? So what's our exit strategy? And in the same way, I think about that with the property stuff. And I've one of my relatives had a picture postcard countryside cottage, and I mean to die for. River running through it, acre of the most stunning land, wisteria growing around it, blah blah blah, stunning. But a mile up a track to get to, and even that, what you arrived at was a 15 house hamlet, which in itself was miles from a newspaper, which was miles from a supermarket, and beautiful. But that's an acquired taste. That's a very
unique.
Quite unique asset, and it will appeal to somebody. But try selling that asset. It actually takes years. I think I can't remember now, a year and a half, 2 years. Whereas I know that my two bedroom executive flat in sort of fairly central Manchester, Liverpool, London, Birmingham is going to shift. Now there's a pricing thing, but it's going to shift. And if my downsides are going to get rid of it, I know I can offload it.
So really, if I was going to summarize that section, it's having multiple exits. Does that make sense? Out of the deal. And so you're assessing those, before you've actually got into it. What is the worst case scenario? Can I, in your regard, can I break up the company? Can I sell it off in pieces? Can I change, in property terms? Can I change the tenant type? So if it's geared up for students, can I quickly change my strategy to, I don't know, serviced accommodation? Is there a demand for that? So again, and this is what we obviously, relating what I would call corporate finance world and private equity, relating to what we teach and train people, here in property world, is very similar. Minimum of 3 exit strategies out of that deal. And it's nice to hear that, at the end of the day, the guys who are in, the middle of the city, billions of pounds sloshing around, have a very similar outlook and analysis of investing as what we teach and what we talk to people about. So, okay, so here's the scenario. We've done our scenario-based planning. We think it's great. We've gone through the best case scenarios, worst case scenarios. We've bought the asset, and so I guess the question is that you as a professional investor, when you buy a company or a property, when you can relate that to it, how much do you then manage your asset yourself post acquisition?
That's interesting, I guess, and there is a parallel here in that when you're a professional investor, you definitely saw different styles. Some people are at the extreme hands-off end. They just receive a board report once a month and may or may not read it. And some people are at the almost interfering bugger end. They're like, not only are they on the board, they're at the company every 5 minutes and they're, in everything. I guess we started from the point, there was this old phrase about private equity was all about the 3 M's, and the 3 M's were management, management, and management, i.e., it's all won and lost in whoever's managing the asset, which is effectively your board, your CEO, CFO, etc. And you could sort of say, I can have an average business and make money out of it with a great team, but frankly, I can have a great business with a great idea, but if the team's no good, it won't work. And I do buy into some of that. And I guess the parallel here in terms of who's managing our asset is our source pre-deal, and then our lettings agent post-deal. The one thing, I guess one of my takeaways is about swapping managers. And there was always a bit of a reticence to do it, and it seemed to be a really big deal. And some people, I just think, leave it too late. And I would sort of counsel, don't wait till it's too late and be brave. Kind of do your homework on the manager in the first place. Don't be afraid to do due diligence. Don't be afraid to ask to speak to clients of letting agents or speak to clients of sources to find out what do their last 3 clients say of the sourcer. And in the same way, obviously do our homework on our managers, but sometimes it doesn't work out. And then my other thing is about, don't be too passive. Don't just get see the income hit the bank account and everything's fine. I mean, I guess I can't help the accounting in me. I always think the answer is in the numbers somewhere. So let me see all the numbers. And, from the lettings agent, see, kind of what's going on income-wise, cost-wise, kind of, and be on top of it. And then the thing that you need to keep on top of, both in terms of talking to your existing agent, but maybe other agents, is keep a handle on the market. Because going back to your point about pivoting, I mean, look at, if you're sat in a portfolio now, kind of the macro doesn't look too cute. So what inbound are you getting from your lettings agent? But moreover, is there about to be, like we saw last year when Honda pulled out of Swindon, that's a fairly major event at a micro sort of town level for Swindon. And what impact does that have on the property investment market? And are you being communicated about that effectively by your lettings agent? And do you need to change your strategy? Has your HMO strategy just changed? Or indeed, has your position to hold that asset as a property investor or exit, is it now? Do you need to pivot? And it's like you've got chips in the game. You should be paying attention to the game and understanding, what can I do best with those chips? So I don't think, I'm definitely at the, probably more the interfering bugger end, but, I like to be in the detail. I like to see the numbers, and I like to, so don't be afraid to read around what's happening in the market where you're invested, and, having a scroll around in I don't know, in spare room, for example, what's happening to room rates? There are other data sources out there. You can say, what's happening, are 2-bedroom flats in that area going up, going down, going sideways, are rental rates going up, is big employers coming or going? Where was it we saw the other day that was a huge, was it Amazon? Was Amazon opening somewhere up north? with a huge requirement for staff. And you're kind of thinking, well, somebody who's on the ground there, well, there's an HMO, sort of almost a blue collar HMO opportunity waiting to happen. So
these conversations, again, if I turn around and say, you're somebody who likes getting into the detail, and that's the nature of the person that you are. But for a lot of people, that's not necessarily their natural position. Does that make sense to get into that micro level detail? But what I'm saying is, you still got to do it. Now, whether you outsource that, does that make sense? So, for example, having a mentor, and being able to sort of, we're talking about asset management here. These questions, and I'll relate this recently, with all the COVID stuff going on now, I've got a portfolio of student HMOs, buy-to-lets, single-lets, etc., focused down in Plymouth. Now, the conversation, with the lettings agent immediately was how is this affecting it on the ground? And they turned around and said, well, we're not 100% sure. But again, this is taking personal responsibility. I don't necessarily need to know the micro, but actually engaging and caring about your assets, I think is to the point. And then put that onus on your power team members. So if these questions don't come naturally to you, then ask, for example, if you're an investor on the SI platform, reach out to us. Does that make sense? And talk to us about, you've got some concerns. How do I do this? Either, or even if you've got a mentor, these are the guys who have been there, done that, and like you said yourself, you've been through many recessions already. Yes, not necessarily affected directly in the property market, but there are similar traits and behaviours that will happen. And this is
in the Facebook group, there's and Instagram, there's hundreds of people in there who there's probably someone who's done it before. Whatever your situation is, question is, area is, anybody got a good this in Bradford, there probably is someone who's got an answer. And, all taken with a pinch of salt, kind of you might get 3 answers and, one's rubbish and one's average and one's great, but I've used that as well, and there's a great network of people to ask.
Yeah. And, and everybody who's watching this live now, and there's quite a considerable amount of people watching this, you're in a group of 600 people. 600 people, that's quite a lot of collective information. And again, ask. Don't be scared to ask the questions. And if you never ask, you never find out. To summarise my story about down in Plymouth, at the end of the day, the students was assessed that they were in a pretty good position. University was still existing, still going on an online basis, so quite a good, solid demographic in this current environment. They're still getting loans from the government with their student loans. And in actual fact, the portfolio is, we haven't seen any drop off whatsoever, and 100% people have just paid for their term 3. So it's quite a decent asset class to sort of be in. So, but if I would only know that from asking the questions of my key power teams, etc., and their expertise on the ground. I can't do that from London. I have to ask and I have to know people. So talking about, when we've talked about managing your assets, etc., it's not just the assets. We talk about, just then talking about power teams. We're talking about outsourcing. You mentioned this. You do that. For our investors who are on the call, we talk about that. But lawyers, accountants, surveyors, etc. But on your level, when you were doing it with huge multi-million-pound deals, how does that work at that level?
Again, it's a big version of the same. Team of experts, lawyers, accountants, due diligence providers, specialists, tax. It's much the same. And I guess part of it is lessons learned. Consistently using the same ones as long as they're good enough. Because you learn each other's ways and you get efficient and you learn what works, what doesn't work, and what time to call people and God knows what else. So I think so I touched on this earlier about getting someone who's appropriate. What you don't want is to it was weird. You'd find people who get all excited because they'd say, we've got PwC as our auditor. I think, you will be such a small client for PwC, and I'm pretty sure, you'll end up with the D team. You're not going to be their A-list client. Whereas if you've gone to, UK accountancy firm number 20, you'd probably be pretty significant. And so it's the same about, finding an appropriate team who've got, kind of the right expertise, but where you're going to be meaningful, and also that you've got a think just a decent relationship again with the people involved, so you're going to kind of get good service, and then being very clear on, what's the scope of the work, what fees you're paying. Make sure you've got a contract. We've been around this many times of people doing work. I mean, building contracts is one of my pet topics, of people doing building work with no contracts. Asking for an opinion, as I've said before, kind of, even if you can't get it in writing in the report, ask. What else would I say? I'd definitely say cheapest isn't best. Shop around, but there's the world we live in now is everything is so well reviewed, particularly from professional services. Kind of look at the online reviews and then ask again for recent client numbers, and are they willing to let you talk to recent clients? Kind of when it's and getting referral from people. My now conveyancer was a referral from a mutual friend of ours, Pete, who's used somebody for 10 transactions and glowing, and I trust Pete, so I use this guy, and he's been absolutely brilliant, and I've referred him to probably 5 people since, including SI clients, so that referral piece as well. But much the same, to be honest.
So we were going to do half an hour. We could talk all day, but I think it's hugely insightful. Just to even have this, and I think we'll definitely have a follow up because we've got a lot of people on this call interested in it, and we'll get into different aspects of how we can translate private equity, multi-million-pound deals, the philosophy, the implementation, and how does that translate to people on this call, which predominantly will be people looking to invest in property. So, if I was going to say, if you had one last tip to impart today, to private property investors, what would that be? What would be the number one tip?
Number one tip. Obviously, I'm biased. I'd say use the SI platform, what we built it for.
But why? Just explain why. You say that, with a tongue in cheek, but in actual fact, underneath it all, yes, you have the association, and we both do. But why? Why use it?
The part of the education for me is, I probably, I don't know, I'm off the top of my head, like 20 months investment, 20 months time invested in SI, and it's been eye-opening to me how, dare I say, shady the property investment arena can be. It's just the amount of sharks we've sort of encountered. We're in a lightly regulated arena that is very poorly policed, and unfortunately it's a sort of theatre, to use the military term, where people are able to function and be rogue. So going back to the why about the platform, I think we've tried so hard and we'll continue to build on it, trying hard to find trusted people, trusted partners, and then put in place processes and tests and systems and tools to try and give us the best chance of avoiding some of that rogue. Now, it's not a perfect world. We can't eradicate it. It's too big a problem. It's beyond us. But if we can build that system right with the right partners, we can give people a bloody good chance, or a far better chance of sort of being out there and in the ether by themselves.
Yeah.
So I would say, in terms of my tip, beyond using the SI platform, there's a bit of me that sort of says, if it doesn't sound right and it doesn't feel right, or if someone isn't making themselves crystal clear at first glance, then don't be afraid to ask. And I don't think there's anything stupid going, hold on a minute, just do that again, and also don't be afraid to walk away. There's people, I think people sometimes get, how do you call it? It's like deal fever, kind of, I'm here now, it's my first one and I've got to do it. And also I've already spent £1,000 in, surveyors and whatever, I've just got to keep going. You don't, you can stop. Better off a few quid lost on a survey that didn't work out, and boy have I done some of those, than ending up with buyer remorse is much worse. Once you've completed the deal and you've got a crappy asset. So I think there's a bit of combining the quantitative and the analytics with qualitative, which gives you that sense of gut, kind of about does this feel right? So I think that would be my 2 pence.
I'm going to add to that and say, and then to be able to operationally execute, please use systems that allow you to have control of money movement, of accountability, whether it be legal contracts, And as a and this is what we have built from head to toe all the way through the sourcing investment platform. Integrated contracts, so you're covered with regard to any disputes that happen between you and the sourcing agent or anybody else on the platform. Is all accounted, and these things are there to be easy to use, but at the same time, the power in them protects you every step of the way, and that's what we've built. So please check it out, and like we always say, join our Facebook groups. Please, any of our recordings, etc., are on our YouTube channel. So and come for a 10-day free trial if you're an investor. And any sources watching this, is please as well. We've got the ability to have a 10-day free trial as well. So please come in, take a look. This is changing investors' lives. This is changing sourcing agents' businesses to be more efficient and, more importantly, generating more revenue. So this is about an ecosystem of building it together, and it's working. And it's been 5.5, nearly 6 years in doing so. So this is not our first rodeo. Mate, thank you so much for today. I know you keep saying to me, oh, it's half an hour, stick to half an hour. Well, just to let you know, we're nearly at the hour mark and we haven't even warmed up yet. So, you can see how hard it is when you get in the flow. So without, as we're doing this with lots of other people, Del doesn't know this is coming. We like to get to know everybody a little bit more. You've probably seen that Del and I had the coffee mornings on our YouTube channel, which is going out on all other Facebook and Instagram of Coffee Morning with Chris and Del. But now I'm going to put Del on the spot himself, and he has no idea this is coming either. He doesn't know what I'm going to say. So we're going to do 60 seconds on the clock. This is going to be quick fire questions, okay? And he genuinely doesn't know where it's going, so we're going to have a little bit of fun here. So I'm going to put you on the spot, mate, and so try not to worry too much. So 60 seconds on the clock. Here we go. Last song you downloaded or listened to?
No idea. It would have been on Kiss FM this morning.
Fill in the blank. Taylor Swift is
going on too many dates. That's what I hear.
Would you rather be able to speak every language in the world or be able to talk to animals?
Talk to animals.
Cake or pie?
Both. Pie.
What's the fastest speed you've ever driven in a car?
I grew up in Germany, so no holds barred. Yeah, I've done the whole fast Audi, I don't know, 170 or something, kind of, yeah.
Nice. What type of milk do you put on your cereal in the morning?
I don't have cereal. I have protein shakes. Look at me. I'm a god.
Athlete. How many redheads are you friends with?
Ooh. No idea. I genuinely no idea. I can't.
Who's your favourite Harry Potter character?
I'm not a massive Harry Potter man. The big giant one. Only because it's Robbie Coltrane.
Hagrid. I'm a Harry Potter fan. Hagrid. If there was hair in your soup at a restaurant, would you return it?
Yes.
Are you a morning or night person?
Morning.
How do you like your steak cooked?
Rare, medium rare.
How many books have you read so far this year?
6.
On a scale of 1 to 10, how cool are you?
5.
And what colour's your toothbrush?
White. Toothbrushes are white unless you get Star Wars one.
We're done. No, that was awesome. Really good, mate. And
no, this is going to be cool. I'm sat here with my Star Wars pencil.
It's such a geek. I love it. But thank you so much, mate. And we've got some questions, but I think we've got some other bits and pieces to do today. I've got 3 sourcer calls who are coming onto the platform, so it's all exciting non-stop. But thank you so much, mate. It's been really good.
Can I just say hi to all my ginger friends who I forgot?
We do have fun here at SI. So anybody, any questions at any time, reach out to us. We're completely available. Again, join our Facebook group, exclusive content. We've got webinars like this, which is not just about property investing. It's all stuff that's related. It's Investments family. But thank you so much, mate. Really appreciate it. And I'll probably talk to you in a bit after we're doing some day-to-day work. But thank you so much for watching, everybody. Appreciate it. Thank you so much. We'll see you next week on Tuesday with more exciting guests. Take care. God bless.